Welcome back to Market Pulse Report. We're diving into one of the most dangerous misalignments in modern economics, the collision between youth wage stagnation and exploding housing costs. And today, we're identifying which stocks and sectors will face the first real shock when this gap finally snaps. Here's the brutal reality. The narrative of just get a job and build wealth is mathematically dead for an entire generation. And the numbers prove it. Let's start with what the data actually shows. According to Bureau of Labor Statistics quarterly releases from 2019 through Q3 2024, median wage growth for workers aged 25 to 34 has averaged 2.1% annually when adjusted for inflation. Meanwhile, research from the National Association of Realtors and Zillow Housing Tracker shows median housing costs in major metropolitan areas have increased 47% over the same 5-year period. That's not a gap. That's a chasm. Consider the math. A 25-year-old entering the job market in 2019 with an entry-level salary of $38,000 would see that wage grow to approximately $42,100 by 2024, accounting for the 2.1% real wage growth. But the median home price in that same market, it moved from $285,000 to $420,000. The mortgage payment on that home, assuming a 7% interest rate in today's environment, jumped from roughly $1,900 per month to $2,790 per month. That's a 47% increase in monthly housing cost versus a 10.7% increase in annual income. This isn't theoretical. This is the setup for a consumer credit crisis. The Federal Reserve Survey of Consumer Finances reveals that households headed by individuals aged 25 to 34 are now carrying an average of $38,000 in total debt. Student loans, auto loans, credit cards, and increasingly higher mortgage balances to bridge that affordability gap. The research shows this demographics debt-to-income ratio has climbed to 44%, up from 32% in 2010. That's a 38% deterioration in household balance sheet strength in just 14 years. Now, here's where this becomes a market event. Wall Street's consensus pricing doesn't fully reflect this deterioration yet. The S&P 500 has historically returned approximately 10% nominal annually, or 7% in real terms when adjusted for inflation, over the past 80 years. But that return assumes healthy consumer debt servicing. When young households start defaulting on mortgages and auto loans, the two largest consumer credit categories, the sectors most exposed take the hit first. Let's identify which ones. Mortgage rate have been a popular defensive trade. Stocks like Ank Investment Corp., New Residential Investment Corp., and Two Harbors Investment Corp. all yielded 12-15% annually through 2023 and early 2024. But here's what the analysis reveals. These companies profit when mortgage pools perform and interest rate spreads remain stable. Once default rates accelerate, which historical recession data suggests happens 6 to 9 months into an economic contraction, mortgage rate portfolios see impairment losses. In the 2008 housing crisis, mortgage rates saw equity values decline 60-80% as realized losses on underlying pools exceeded pricing assumptions. The average post-WWII recession lasts approximately 11 months. If we're entering a period where youth consumer defaults spike, these instruments face real deterioration. Homebuilder stocks face a different but equally severe pressure. Companies like Lennar, D.R. Horton, and Pult Homes have seen stock valuations climb 25-30% through 2024 as investors bet on continued housing demand. But research shows that demand narrative is fragile. When entry-level buyers, the segment that props up the 200, 000-300, 000 housing unit range that drives volume for most builders, step out of the market due to affordability collapse, revenue growth stops. Earnings typically decline 40-60% in the next fiscal year. Historical patterns from 2006-2008 show homebuilder stocks bottomed after falling 70% from peak valuations. Consumer discretionary retailers face similar exposure. When young households are spending 42% of gross income on debt service, they're not buying furniture, apparel, or electronics. BLS data on consumer spending patterns shows that households in the 25-34 age range allocate roughly 23% of disposable income to non-essential purchases when debt-to-income ratios stay below 35%. Once that ratio crosses 42%, discretionary spending collapses to 8-12% of available income. That hits companies like RH, Williams-Sonoma, and even the lower-income-oriented retailers like Five Below. Here's the pattern interruption. Utility stocks have historically outperformed during recessions. Research from market analysis firms tracking the past 3 recessions shows that utility stocks, companies like NextEra Energy, Duke Energy, and Southern Company, delivered positive returns or minimal losses when the broader S&P 500 contracted 20-40%. Why? Because essential services hold demand regardless of economic conditions. Studies suggest that in the 2001 recession, utilities were down 8% while the S&P fell 47%. In 2008, utilities were down 24% while the broader market collapsed 57%. This isn't coincidence. This is sector rotation into safety when consumer balance sheets deteriorate. Let's quantify the exposure another way. According to Federal Reserve data, consumer credit ex-mortgage outstanding is approximately $4.8 trillion. Auto loan delinquencies are already trending upward. Data shows subprime auto loan 90-plus day delinquency rates hit 5.2% in Q3 2024, the highest level since the pandemic. That's a leading indicator. When young workers can't service auto loans due to housing cost pressure, mortgage defaults aren't far behind. The wage-to-housing mismatch also reveals a secondary effect: geographic rotation. Markets with the most severe affordability crises, San Francisco, New York, Los Angeles, Boston, show elevated early-stage delinquencies among younger borrowers. Meanwhile, secondary markets like Austin, Phoenix, and Nashville show more resilience, but only because younger buyers are migrating there, and those markets are now experiencing the same price appreciation. The crisis isn't localized, it's expanding. Here's what Wall Street is missing. The narrative of millennials just need better jobs obscures the real problem. IRS publication data on wage and income trends shows that real wage growth in professional occupations has slowed to 1.8% annually, even in high-demand fields like tech and finance. The job market isn't broken. The affordability math is broken. No amount of job switching fixes a situation where housing appreciation outpaces income growth by 30-plus percentage points annually. The corporate earnings surprise is coming in 2025. Banks with heavy exposure to consumer lending, J.P. Morgan Chase, Bank of America, Wells Fargo, will begin taking loan loss provisions that exceed analyst expectations. Credit card charge-off rates will accelerate, mortgage origination volumes will decline, and the stocks that benefited from the "everything is fine" narrative of 2024 will see multiple contraction. But here's the contrarian signal. Companies with pricing power and essential products, energy, utilities, healthcare, will hold valuation better. Studies on historical sector performance show that during contraction periods, investors rotate into sectors where profit margins are protected by regulation or necessity, not discretionary demand. The data is clear. Youth wage stagnation colliding with housing cost explosion isn't a social issue first, it's a